Right now is Merrill Lynch Private Bank Chief Investment Officer Chris Wolfe. Chris, good to see you.
Yeah, thank you.
Thanks so much for joining us. Look out at the week and at the next couple of months. What's your feeling about markets here?
I think it's going to be a bumpy ride. You have a couple of things going on. Earnings season is going to offer not a lot of guidance. I think margins will stay high, but a lot of people are looking for signs from China over the next couple of months for stabilization, whether it's new 5-year plan, focus on things like pollution control, banking sector reform, and maybe healthcare services to give, I think, a bottoming parts of the market, but we're a ways away.
Yeah, but what about the things coming out in the U.S.? You got the GDP out on Friday. The estimates call for up 0.8%. Consumer confidence out tomorrow. FOMC meeting. Are we going to see anything from the new home sales data or any of the data this week that's going to give us some positive feelings about the economy in the U.S., you think? I
think it really comes down to guidance. A lot of the things you just mentioned have a backwards look to them. GDP data gets revised. The home sales numbers got to recover from December data, which was pretty rough. So I think where we're headed right now is a little bit of an earnings vacuum. And I think the important piece actually is this, which is to remember that, you know, we're kind of reversed where we were 5 years ago. 5 years ago, we were, oh my gosh, we have to worry about the stock market, but the economy was actually, I'm sorry, we had to worry about the economy, but the stock market was doing really well because the globe was doing well. The world had growth, but this is the other way around. U.S. consumers great, economy's good, but the rest of the world not doing so well. So that's translating through corporate profits and putting a little bit of I think, a shakeup in the markets right now.
Chris, talk to us about earnings, because I think that's fundamentally what we have to see in the market to see further upside. But, you know, all the analysts have been doing is they've been cutting down their earnings estimates. Yeah. We're at 130 for this year, 1 point now we're at 125, and maybe below that. Is there something in the earnings season, any forward guidance that comes out of that would give you more optimism?
Typically not the beginning of the year. We might get it in the March-April timeframe. I think the earnings story is right, though. That's ultimately what drives markets. Interestingly enough, the sales numbers have not come in as bad as a lot of people thought. Between sales and earnings, there's a little bit of upward lift here, I think, around the point that Maria was making. But with the energy numbers due to come out soon, you're probably going to have a little bit more pressure. I think the bottom line is this, though. The world still has a lot of earnings pressure to feed through U.S. companies because it's slowing down a bit. And that China story hasn't played out. It's going to take a while for first quarter numbers to really produce anything.
It sounds like you are seeing more negatives than positives in this market right now.
I think you're going to have a bumpy ride. I think for investors thinking about where to position here, it's much more selective. The call around asset allocation, kind of focus on stocks versus bonds, is a good one. But I think the key here is really the higher quality, less leverage. It's a little bit of a consensus trade, but it's a good place to be while we get through a pretty bumpy period.
Chris, do you think there's something systemic wrong with the market that's contributing to this volatility, or do you think it's just uncertainty about earnings and the overall global economy?
I think there's the global economy. We have the leakage from oil prices, and I think we have other things going on. Market technicals are not great. We have, you know, a lot more algorithmic, rule-based trading and a lot more sensitivity to having a negative return. 2 years of asset allocation have made kind of a stock and bond portfolio have made about zero return. So greater sensitivity, which means people are just willing to cut off the left side, meaning when the market goes down, they just sell no matter what. That's a rule in the market, kind of pushing things maybe more to the extreme than we've seen.
You saw positive comments from Mario Draghi, positive for the markets, clearly that more stimulus might be on the way in March. But do they have any mojo left? Central bankers around the world, is that foolish to get excited about more monetary stimulus? Does it not have enough impact?
Not foolish, but that's a Pavlovian response I think markets have adopted over the last couple of years. I think the take here is that if Draghi basically has to deal with collapsing inflation expectations in Europe, not just the oil prices, but consumption, et cetera, down pretty strongly. So they're going to need a lot more stimulus, and I think that's really the key here. So markets will play a little bit off.
By the way, coming out of Davos, I don't know how you felt about it, Anthony, but virtually everybody I spoke with on the CEO side or on the strategist side said it was Europe that they were looking at. That was the opportunity in terms of buying equities.
Well, the quantitative easing is still in place there as well.
So that's an interesting play, exactly, because of quantitative easing and the domestic economy is improving there. But, you know, when we're talking about China, China is a far bigger drag on Europe than it is on the United States through the trade linkage alone.
Sure.
So, Chris, maybe how do you reconcile that, or how do you reconcile China? How do you square China in the first place? Because they're fighting so many battles right now. Can they win them all?
Can't win them all, but I would say a couple things. One is the linkages, you are right, more through Europe, also through Latin America, and more broadly through Asia. Taiwan, Korea, Singapore, Philippines all struggle when China's coming off the boil. I think our view is kind of lynched on two things. The first is you have companies that have responded to this environment by raising their profit margins. They're swapping people for robots in many ways, keeping the kind of cost structure very low. So that is pretty good in terms of the margin story, and we've seen that result in higher operating operating leverage, meaning you only need a little bit of sales growth to get a lot of earnings growth. So markets are kind of geared up for that. So while a lot of the bad news on revenue lines starting to filter through, a little bit of good news later this year could turn into pretty good profits.
Well, by the way, you mentioned earnings. I think Apple and Amazon are also reporting this week.
They are.
We're going to finally see if, in fact, what we thought around the Christmas holidays is coming true, how their fourth quarter was. Because Amazon and Apple were like the only game in town in terms of where people were spending money.
Yeah, that's right.
Right, because you're not going to see it in consumption numbers out of GDP, for example, 1.8% versus 3% the quarter before. But hopefully we'll see that the biggest winners are the
Before we get kind
retailers.
of all negative, there's a really bright spot to this, which is consumers, 70% of the economy, they're in really good shape. You know, their debt service ratio is a lot lower. Their trajectory for growth might be longer, more durable. So the idea that you go in a recession seems really far away.
Unless people get so freaked out by the negative talk and what the market's done that they pull back.
Confidence.
Right.
All right, we'll leave it there. Chris, thank you. Thanks so much for your insights. Chris Wolfe there. News.